The global economic landscape is shifting in ways that are forcing governments to explore policies that would have been dismissed not long ago. The United States, facing pressure from rising inflation persistence, geopolitical fragmentation, and tightening global energy markets, has quietly signaled a proposal that involves both China and Venezuela. The goal is not cooperation in the traditional sense. It is an attempt to stabilize energy costs, slow the formation of a commodity-based BRICS power center, and regain influence over markets that are becoming less responsive to Western policy tools. The core of the proposal has two distinct components. The first is aimed at China. U.S. officials have indicated a willingness to provide limited predictability in areas that matter for China's industrial stability. Specifically, selective tariff clarity, narrowly defined supply chain permissions, and controlled access to certain intermediate goods. This does not represent a shift toward broader normalization. It is a temporary, functional arrangement designed to reduce volatility in a global system where supply chain tensions have direct effects on U.S. inflation and long-term yields. In return, the United States wants China to slow the deepening of its involvement in Venezuela's oil sector and to resist efforts within BRICS to build coordinated energy frameworks that could challenge the dollar-centered financial structure. China's financing of Venezuelan infrastructure, its long-term oil offtake agreements, and its broader commodity strategy give Beijing growing influence over marginal barrels in the global market. For Washington, this influence is increasingly consequential because it limits the effectiveness of sanctions and weakens traditional leverage over energy prices. The second component of the proposal is directed at Venezuela. The United States has signaled possible sanctions adjustments, targeted licensing for U.S. energy companies, and limited access to certain financial channels. These are not designed as incentives for political reform. They are pragmatic tools to stabilize Venezuelan output and prevent the country from locking itself into exclusive long-term supply arrangements with China or from contributing to a BRICS-aligned commodity system. For Venezuela, the potential benefits are immediate. The country needs investment, equipment, and access to markets to restore production capacity. But the United States also understands the constraints. Venezuela's economic dependence on China is significant, and any shift in alignment carries risks for Caracas. The U.S. proposal is structured to give Venezuela economic space without forcing a public geopolitical realignment. What makes the proposal unthinkable is not the specific terms, but the reversal of long-standing U.S. posture. For years, the United States pursued maximum pressure on Venezuela and escalating industrial restrictions on China. Now, facing a world where multiple countries are building alternative financial channels, where commodity supply is increasingly politicized and where energy volatility has direct domestic impact, Washington is engaging with both states simultaneously. This reflects a broader reality. The global system is fragmenting, and achieving stability requires navigating a landscape with multiple centers of economic influence. The U.S. cannot fully isolate Venezuela without strengthening China's position. It cannot significantly escalate technical tensions with China without risking disruptions that feed back into its own inflation cycle. The proposal sits at the intersection of these constraints. From an economic perspective, the key issue is energy. A coordinated BRICS energy structure involving China, Russia, Brazil, the Gulf states, and possibly Venezuela could change price dynamics, shift trade settlement patterns, and weaken the reach of U.S. sanctions. Even the perception of such coordination creates instability in financial markets. The United States is attempting to manage these risks by limiting the pace at which this alternative system develops. The proposal is ultimately a defensive mechanism. It aims to protect the stability of the global financial architecture, maintain influence over marginal energy supply, and slow geopolitical consolidation among countries that have increasingly aligned around commodity power. It does not guarantee results, and it does not resolve the underlying structural tensions. but it shows that the US is now operating in a world where flexibility is no longer optional and where strategic engagement is required even with governments it has spent years confronting. A critical part of understanding this moment is recognizing the structural pressures shaping US behavior. The traditional tools used by Washington to influence global outcomes, sanctions, the dollar system, military alliances, and technological restrictions, are becoming less effective when multiple countries coordinate their economic strategies. The growth of BRICS, the rise of alternative payment systems, and the increasing willingness of nations to diversify energy relationships are all indicators of a system undergoing rebalancing. In this environment, rigid policy frameworks produce diminishing returns. Energy is the central variable. The global oil market is no longer dominated by a single block of countries aligned with Western interests. Instead, supply is being reoriented through discounted barrels from Russia, long-term Chinese financing of overseas oil infrastructure, production policies centered around domestic priorities in the Gulf, and a potential resurgence of output from Venezuela if investment resumes. The United States sees a world where key energy flows may increasingly bypass traditional Western oversight. This matters because energy influences every other segment of the global economy. Inflation dynamics, interest rate expectations, the resilience of emerging markets, and even geopolitical stability are all connected to the price and availability of oil. When the United States cannot reliably influence marginal oil supply, its ability to manage domestic economic risks becomes more constrained. The proposal to China and Venezuela acknowledges this reality. Another factor is the weakening predictability of global trade channels. Supply chain diversification, which was initially seen as a strategy to reduce dependence on China, has produced unintended consequences. Production has spread across more regions, increasing exposure to geopolitical risks in multiple parts of the world. Meanwhile, China has maintained its position as a central hub for critical manufacturing inputs. This means the US cannot fully decouple from China without generating domestic cost pressures. Offering selective stability to China is a way to mitigate these pressures without altering the broader strategic competition. For Venezuela, the situation is equally complex. The country's oil sector has the potential to add meaningful supply to the global market, but only if it receives capital, equipment, and a predictable export channel. China can provide financing, but not rapid integration into Western markets. The United States can provide market access, but only if sanctions are adjusted. This creates a triangular dependency in which each actor influences the choices of the other. The U.S. proposal attempts to shift this triangle in a way that slows the formation of a BRICS-aligned energy bloc. On the financial side, the U.S. is also responding to growing experimentation with alternative settlement mechanisms. Bilateral trade between China and several commodity-producing nations is increasingly being conducted in local currencies. Russia and China have expanded the use of non-dollar payment networks. The Gulf states are exploring linkages between digital currencies and energy pricing. None of these developments individually threaten the dollar's global role, but collectively they represent a trend. A strengthened BRICS energy partnership would accelerate that trend. The United States is using this proposal to reduce momentum behind these experiments. By offering limited but strategic concessions, Washington is signaling that there is still economic value in engaging with the dollar-based system rather than building alternatives. The objective is not to restore the old order, but to slow the emergence of a parallel one. It is important to emphasize that these moves do not indicate a new period of cooperation. The underlying tensions between the United States and China remain. The political disagreements with Venezuela remain. The broader strategic rivalry remains firmly intact. What is changing is the recognition that complete isolation is no longer a viable strategy in a more fragmented world economy. Flexibility is becoming a forced requirement rather than a chosen policy direction. The consequences of this approach will unfold gradually. If it succeeds, the US could regain limited influence over Venezuela's production, slow BRICS energy consolidation, and prevent rapid expansion of non-dollar settlement channels. If it fails, it may accelerate exactly the trends Washington is trying to contain. China may increase investment in Venezuela regardless of US incentives. Venezuela may use US concessions to negotiate better terms with Beijing, and commodity-producing nations may still seek alternative frameworks for trade and finance. This uncertainty is part of the broader global transition. The international economic system is evolving away from a model built on centralized influence toward one defined by distributed power centers. The United States is adjusting to this environment by combining selective engagement with strategic pressure. The proposal to China and Venezuela is an example of that adjustment, a calculated attempt to manage risk in a world where no single country can shape outcomes alone.